Hey guys, welcome back to another video. Today we'll be talking about common balance sheet mistakes that I've seen throughout my career as a corporate controller over the last 16 or 17 years. So we'll talk about these common balance sheet mistakes, and we'll talk about ways to mitigate them and hedge against these mistakes from happening. And if you stick around till the end of the video, which I highly recommend, I will share with you one final bonus tip about the most common balance sheet error that I've seen and how do I personally go about preventing it. If you are new to the channel, welcome. My name is Bill Hanna. I'm a licensed CPA in the great state of New York, and I've been working as a corporate controller over the last 17 years. And the purpose of this channel is for me to download my knowledge over into you so that you can debit your confidence and credit your self-doubt, if that's even proper accounting. So let's dive into today's topic. All right, let's begin with an obvious kind of mistake, right? When we say balance sheet, it means that it needs to balance, right? The assets need to equal liabilities plus owner's equity. So if you're looking at any balance sheet, for example here, assets is $1 million, total liabilities and equity is also $1 million. The reason for that is that the accounting equation, which is the basis for everything in accounting, dictates that assets equals liabilities plus owner's equity. Why is that? Because what we own in the business, which is assets, will always have to equal what we owe. And what do we owe? We owe liabilities to third parties, and we owe equity to the shareholders of the company. So it's a very easy concept, right? What we own equals what we owe. That's the basic accounting equation. So when we're looking at a balance sheet and it's not balanced, right? First of all, this is near impossible to happen in an ERP software, right? The reason is whenever you're booking any accounting journal entry in ERP, the ERP will require you that your debits will always equal your credits. So therefore, it's near impossible for a mismatch or an imbalance to happen with any entry in the ERP software, right? Which means that most likely what happened is your data got corrupted between the transfer from ERP into Excel. Or whenever you manipulate the data in Excel, somebody pressed the wrong button in Excel, clicked on a number, changed it, made it wrong, and therefore you have an imbalance in your balance sheet, right? So what you need to do is check on the source of the data in the ERP software to make sure that it balances. If it doesn't, it means that maybe something is wrong in the setup of the ERP software, right? So maybe in the consolidation piece of it, if you have multiple entities, or maybe in the foreign currency translation. So you'd want to check with your IT resource to figure out where is the source of that imbalance in the balance sheet. So know that it's impossible, near impossible to happen in ERP software and more likely to happen in Excel. So you want to double check and go back to your source to make sure your data is correct. And of course, if you want to get deeper into these topics, I highly recommend you join hundreds of other accountants who join my Controller Academy program. I'm going to leave a link down below in the description. Okay, the second common type of an error that I've seen in a balance sheet is a misclassification between the assets and liabilities. Let's take a look at an example. So you have the liabilities section here of the balance sheet, and you have claims payable. And it's a negative value, $25,000, going in the opposite direction of the rest of the liabilities. This here most likely means that this is not a payable item. This means probably that you need to reclassify this into an asset. And most likely this is a receivable in this case, right? Because it's a liability that is going in the opposite direction of the rest of the liabilities. So the nature of the liabilities is to have a credit balance. In this case, this has a debit balance, which means most likely it's a receivable. So at the end of each financial period, you need to be examining your assets and liabilities and take a look at the numbers. Is any of the numbers going in the opposite direction of the rest of the numbers of the assets and the liabilities section? That's how you catch this kind of mistake. Okay, the third type of a common balance sheet mistake that I've seen is a misclassification between long-term and short-term assets or liability, right? So the difference between short-term and long-term is short-term is realizable within 12 months. Long-term is something that's going to be beyond 12 months in nature, whether it's an asset or liability, right? So let's take a look at this example. We have the liability section of a balance sheet, and we have accrued expenses for $250,000, right? What we need to do in this case is take a look at the underlying detail, or usually in Excel, what's inside of the $250,000. In this case, when we look at the table, we'll see legal fees that is going to be paid within 3 months for $150K. And sales tax for $100K, that's going to be paid within 18 months, right? So this is a longer term liability, right? It's sitting under current liability by accident. it should be reclassified as a long-term liability, right? So at the end of each financial period, you need to examine the underlying schedule for your balance sheet items, assets, and liabilities, and double check for the nature of whether it should be under current liabilities, long-term liabilities, current assets, long-term assets, this kind of thing. And that's how you catch this kind of mistake. All right, common mistake number 4 is going to be related to valuation. Let's take a look at an example of the assets section of a balance sheet. We'll see under current assets, we have a few things. We have cash, we have accounts receivable, we have inventory. And some of the mistakes that I've seen are going to be related to the valuation. So for accounts receivable, it's sitting here at $4 million. But what I see sometimes is that the accountant would forget to create an evaluation or an allowance for doubtful accounts. Right? So the 4 million is not all expected to be collectible, right? Because you have some customers that won't pay you for whatever reason it is, right? So you need to create an allowance for doubtful account, right? So this 4 million isn't really 4 million. It's more like maybe 3.8 million, because if you go through the process of creating the allowance, you'll realize that not all of the 4 million is collectible, and therefore you need some sort of an allowance against it. Same thing for inventory. What I've seen happen is that you either forget to write off expired or damaged inventory, right? So what you need to do as an accountant is to look at a report at each month to figure out whether your inventory is all sellable, right? If you have expired goods, obsolete goods, damaged goods, lost goods, it needs to be written off, right? So if you forget to write it off, that's a mistake. You don't value your inventory at lower of cost or net realizable value. So inventory needs to be valued at the lower of either historical cost or net realizable value. Net realizable value being the selling price minus all of the costs associated with selling the inventory, right? So this is another common mistake, is that you're not looking at your inventory and revaluing the lower of cost or NRV. A very similar thing will happen down here with goodwill. So we have here goodwill sitting at $1 million, and goodwill results usually in a transaction like an acquisition. And the result is the difference between the acquisition price minus the fair market value of the assets and the liabilities being acquired. The difference is called goodwill, right? You record that, but you need to go through an impairment test at the end of each financial period, right? And the impairment test would compare the current fair market value versus the carrying value of the asset, and take an impairment if needed. If you forget to do or neglect to do the impairment test, that will result in a valuation mistake. So this is just a couple of examples of the valuation mistakes. There are a few others related to investments and some other things and some other intangible assets. These are just some examples just to get you thinking about the kind of valuation mistakes you could be making with the balance sheet. And as I promised at the beginning of the video, I'm going to share with you one of the most common types of mistakes that I've seen with the balance sheet and how to mitigate. Let me share an example to make it easy. This mistake has to do with not releasing old accruals. So the example is, if we're looking at the liabilities section of the balance sheet and I have accrued expenses for $250,000, I break it down further what's underneath the $250,000, and I find that it's made up of legal fees, $150,000, sales tax, $100,000. That makes up the $250K, right? What happened here is the $100K that I accrued as sales tax. This is an item that I accrued based on the advice of outside tax advisors. They told me that I owe $100K for back taxes to the state, right? The mistake that I've seen happen is that you don't go back and check in the future whether you still owe this money or not, right? So what you need to be doing at the end of each financial period is to check again with your tax advisors whether your product taxability changed, whether one of your large customers maybe has an exemption certificate. Basically, do I still owe the 100K, or maybe I owe 50 or 25K? Maybe the number changed, right? So the mistake that I've seen happen is that you don't check and see if that number changed, whether it go down or go up, right? So you need to revisit that at the end of each financial period to double check that you still owe this money. And that's it. Thank you so much for watching till the end, and I'll see you in the next video.